Right now, the COMEX vaults are telling you one story and the price chart is telling you a different one entirely. Registered silver inventory in New York keeps shrinking. The spot market keeps trading tighter against the futures curve, a condition traders call backwardation, and it typically means real metal for immediate delivery is scarce. And yet, since the middle of June, silver has fallen roughly 17%. If the physical market is this tight, why does the price on your screen keep sliding lower during certain hours of the day and holding steady or climbing in others? That is not noise. That is two different markets fighting for control of the same number, and once you see which one is which, you will never look at a silver chart the same way again. Let's ground this in exactly where we stand today, Thursday, July 16th, 2026. Silver closed near $56.32 an ounce, down 2.5% on the day and down more than 17% over the past month. Even after that slide, silver is still roughly 47% higher than it was a year ago. Oil has been climbing all week after the United States carried out additional strikes on Iranian targets on Wednesday, reviving fears about the Strait of Hormuz, the flow of crude through it. The Federal Reserve's next policy meeting lands on July 29th, and as of this week, the CME FedWatch Tool is pricing roughly a 90% probability that the Fed holds its target range at 3.5% to 3.75%. 3 data points, 3 different forces, one metal caught between all of them. To understand why the price can fall while the physical market tightens, you need to trace the full mechanism, one link at a time, because none of these steps make sense without the step before it. Start with the trigger, not the target. Operations against Iranian infrastructure escalated again this week, and that reignited the oldest fear in the oil market, a disruption to tankers moving through the Strait of Hormuz. A significant share of the world's oil supply passes through that channel, so even the threat of a closure moves the price of crude within hours. Before we get to silver, we need to understand what a spike in oil actually does to a central bank. Higher energy costs feed directly into headline inflation, and the Federal Reserve has spent years trying to convince the market that inflation is under control. A fresh oil shock threatens that story, which means traders start pricing in a Fed that stays higher for longer rather than one that cuts sooner. This only makes sense once you see what a hawkish Fed does to the dollar and to real yields, because both tend to firm up when rate cut expectations get pushed back. A stronger dollar and higher real yields raise the opportunity cost of holding a non-yielding metal like silver, and that is the signal algorithmic and macro trading desks are built to react to instantly. Here is where the mechanism becomes visible on your screen. Much of that reaction does not happen during the New York trading day, when volume is heaviest and price discovery is most efficient. It happens during the Globex overnight session, when Asian and early London desks are working with a fraction of New York's liquidity, and when a relatively modest futures sell order can move the price of the continuous contract far more than the same order would during peak hours. Think of it like water moving through 2 pipes of very different width. During the day, the pipe is wide, and even large flows barely change the pressure reading. Overnight, the pipe narrows dramatically, so the same volume that would barely register at noon can swing the reading hard before dawn. That is the mechanical reason silver's price often looks like it is being pushed lower in bursts during quiet hours rather than drifting down smoothly through the session. Before we get to the consequence, we need to understand the cause, and the cause is thin liquidity meeting macro-driven futures selling. Now here is the part that keeps this from being a simple bearish story. None of that overnight futures selling changes how much physical silver is sitting in a COMEX or London vault. Registered COMEX inventories have kept declining even as the futures price fell, and that is precisely why backwardation has not just held, but in places widened. The paper price and the physical price are being pulled by 2 different forces at the same time, one driven by macro positioning and thin overnight liquidity, the other driven by whether an industrial buyer or a bank can actually get bars delivered this week. That is the oddity in the title of this video, and now you understand exactly why it exists. Here is what most mainstream coverage of this pullback is missing entirely. Most commentary treats the 17% monthly decline as proof that the tightness story was overblown. But COMEX delivery data tells a different story, because registered stocks available for delivery have continued shrinking through the same period the price fell, and reporting tied to Chinese export restrictions suggests tens of millions of ounces of supply have effectively gone offline since the start of the year. When a market can absorb a double-digit price decline in the paper contract without easing the physical shortage at all, that tells you the paper price and the delivery market have partially decoupled, something the Silver Institute has flagged as a structural risk worth watching heading into its next World Silver Survey. That is not a detail you get from a headline that just says silver fell 17% this month. If you are the kind of investor who wants to understand a move like this before it shows up as a headline rather than after, this is exactly the kind of analysis worth having in your corner going forward. I break down these mechanisms every time the market disconnects like this, before the explanation becomes common knowledge. Subscribing means you see the next one of these the moment the data starts diverging, not 3 weeks later, when everyone else finally catches up. That is the entire edge, being early to the explanation rather than late to the reaction. Now sit with a harder question for a moment, because this is where most investors either build real conviction or discover they never had any. There are two versions of you holding silver right now. One version understands exactly why they own it, can explain the backwardation story in one sentence to a stranger, and has a clear condition that would make them change their mind. Something like a sustained move back into contango or a reversal in COMEX withdrawals. The other version bought because the chart was going up, got uncomfortable when it stopped, and is now quietly hoping the number on the screen goes back to where it was, so the discomfort ends. Neither version is foolish, but only one of them has a plan for what happens if the price falls another 10% from here, and only one of them will know whether that drop confirms their thesis or breaks it. Which version were you this week? From here, the path forward splits into a few clearly defined scenarios, and the data between now and a specific date will tell us which one is unfolding. Call the first scenario the confirmation path. If the Fed holds rates at 3.5% to 3.75% on July 29th, as the CME FedWatch Tool currently expects, and if the Strait of Hormuz situation does not escalate into an actual disruption of tanker traffic, expect the dollar and real yields to ease back, expect the pressure from overnight futures selling to fade, and expect silver to work back toward the $58 to $65 range as the backwardation story reasserts itself in the price. Call the second scenario the stress path. If tensions escalate in a way that threatens actual shipping through the strait, oil could spike further. The Fed could signal a genuinely hawkish tilt at that same July 29th meeting, and macro funds could keep leaning on the paper price, even as physical delivery gets harder to source. A combination that could push the headline price down toward the low 50s, even while backwardation widens further, which would be the clearest signal yet that paper and physical have split. Call the third scenario the resolution path. If tensions in the Middle East cool and the next round of COMEX warehouse data, along with the Silver Institute's supply figures, show registered stocks stabilizing, expect the market to settle into a calmer range, somewhere between $55 and $60, while the extreme daily swings fade. I am not going to tell you which of these is more likely. The data coming out of the July 29th Fed decision and the weeks of COMEX warehouse reports that follow it will tell us which path the market has chosen. And that is exactly why this is a story worth returning to, rather than one you can resolve today. So here's the question I actually want you to sit with, and it has nothing to do with where silver trades next week. When a market shows you two contradictory signals at once, the physical side screaming scarcity and the paper side screaming weakness, what does your instinct to trust one over the other say about how you actually think markets discover truth through the price everyone can see or through the metal nobody can easily get their hands on? Leave your answer in the comments, because that conversation is one I read and engage with. This is for education and discussion only, not personal financial advice. I am sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.